One question that I get often is that what determines the PE ratio of a company, or why is it that within the same industry companies have a whole range of PE ratios? And to simplify matters, there are three determinants of the PE ratio. The first one is the interest rate, which is something I've spoken about in another video, and I will give a link to that. That as interest rates in an economy go up, the PE ratio, the valuations of the stocks shrink. The second factor, which is much better understood, is the growth rate in earnings. So the higher is the sustainable growth rate in earnings of a company, the higher will be the PE. And the third factor, which not that many people don't focus on, is the returns that the company is making, the return on equity, the return on incremental capital. So the higher the interest rate, the lower the PE, the higher the growth rate, the higher the PE, the higher the return ratios, the higher the PE. And if you want a formula, the formula is 1 minus G by R, that's the numerator, divided by K minus G, whereas G is the earnings growth rate, R is the return on incremental equity, and K is the cost of equity, which is the risk-free interest rate plus the equity risk premium. So remember the three factors. And for those of you familiar with the finance, this is actually similar to the terminal value calculation in a DCF, in a discounted cash flow model. So you have the framework. Now the tough part is to estimate all of these factors, not just for 1 year, but for the long-term forecast for the company. But at least it gives you a framework to start work. So hope that helps.